When we're talking about creating a project portfolio management system, in order to determine which projects we select and which projects we reject, the reasons that we want to create that kind of a system are that it makes it easier for us to strategically decide on which projects we want to keep and which we don't. It also eliminates the idea that we would take on projects because we feel good about the projects or a senior manager is thinks that the project is really important. It allows us to remove those politics and emotions and cultural issues within the company from the idea of the projects and just focuses on financial and strategic goals. Also allows us to balance risk, and it makes it easier for us to get rid of projects that do not support our strategy, especially those projects that are being supported just on a political or emotional need within the company rather than a strategic goal. When we're building this project management system or portfolio management system, we're going to consider several things. We're going to look at each one of these items individually in the next couple of slides. So the first thing that we are going to do is we're going to classify projects. We're going to have compliance projects, operational projects, and strategic projects. Those compliance projects are projects that we have to do in order to meet certification requirements, government regulation requirements, any other laws that have been passed down. So we might have to implement a project in order to follow those laws. Maybe we need to reconfigure an office space in order to meet different compliance, such as ADA compliance. So if we're in an older building, that building might not meet ADA compliance with requirements for how much space is in a hallway, how much space is between furniture and offices, how much space is available in a doorway, then we would have a capital project where we are remodeling our office space to meet a compliance. Then we would have operational projects. Operational projects are those projects that are going to benefit our everyday operations. Maybe we're going to implement a new software system that makes keeping track of information easier. The strategic projects are those projects that help benefit the strategy of our organization. This is when we're looking at new products, moving into new market spaces, creating a new advertising strategy to sell information. Once we've classified our projects, then we're going to create selection criteria. When we're looking at selection criteria, we have financial and non-financial selection criteria. The financial models of criteria are the payback and net present value models. That's the two that the book focuses on. There are other financial models that can be used, and it's up to the company and how they want to use those. Non-financial models would also look at the strategic information that the company is looking for. So we might have a list of things that say, what are we hoping to do? Are we looking to get a larger market share? Are we looking to attract a new customer base? Are we looking to increase sales in a different area? Do we want to develop new technology? Do we want to reduce dependency on our suppliers? Maybe we're just trying to meet compliance or regulations. Multiple criteria selection models use several weighted selection criteria to evaluate a project proposal. They don't just use one thing, like a financial model. Does the project make money? Yes or no? If yes, Done. If no, we reject it. So with the multiple criteria selection model, we will weight each item in our selection criteria and we will score projects. Then we'll strategically choose projects that have the highest scores. When we're looking at financial models, the first financial model that the book talks about is the payback model. What the payback model does is measures the time the project takes to repay its initial investment. The calculation for the payback model is the total investment divided by projected cash inflows or cost savings. And that gives us the time period that it takes us to recover our investment. The limitations of that is first that it ignores the time value of money. So we know with the time value of money, know that if we invest money, we earn interest on it, which means future money is worth more than the money that we currently have. It also ignores any cash inflows after the time of the payback. It doesn't consider any of those cash flows after we've paid back and that become pure profit on that investment. The other financial model, which is more common, is the net present value. We use the management's minimum desired rate of return, also called the discount rate, to compute the present value on all net cash flows. If we have a positive net present value, then the project's cash inflows are higher than its investment, and we could accept the project. If we have a negative net present value, that means that this project will never recoup its initial investment. If it's a negative net present value, we're going to ignore that project. There's a formula here for net present value, but most net present value calculations will be done in Excel. And I'll post an example video where we look at how to do that in Excel. Most of you have already done that for other classes. So when we're looking at these two, we're looking at an example comparing two projects using the payback period. So we have project A and project B. We have annual savings and a payback period. We have a 15% desired rate of return. So 15% is our threshold for our net present value. So when we do our payback method analysis, we take the initial investment divided by the annual savings. In this case, project A would be greater than project B. We would place a higher priority on it than project B because we pay back project A in 3.1 years or 5 months earlier than we would pay back project B. When we're looking at the net present value method for those same two projects, we're going to discount those cash inflows back using the required rate of return. When we do that, we find that the net present value of project A is positive and the net present value of project B is negative. In the payback method, we could have accepted either project because what our payback requirement is that it was under 5 years. Both projects were under 5 years, so using just the payback method, both projects could have been accepted, meeting financial criteria. But when we look at the net present value method, we can see that the net present value of project B is negative, which means we would never recoup our initial investment given our required rate of return. Then we have various non-financial strategic criteria. This is just a rough example of some of the things that we might think of when we're creating that criteria list of things that we want to focus on for selecting whether we're going to take on a project or not. We have two different ways to use multi-criteria selection models. The first is a checklist model. We use a list of questions to review potential projects and determine whether we're going to accept or reject. This doesn't show us what the relative importance or value of a project is, and doesn't make it easy to allow for comparison with other potential projects. It just shows whether or not we meet our minimum required list of project questions. However, a multi-weighted scoring model gives us a scoring spreadsheet, and it allows us to compare projects with other potential projects based on a weighted score. We're also going to do an example of this in that example video that I'm going to post. We have a list of sample questions that we use when we're evaluating projects. What strategy does this project align with? Do we have a business problem that it solves? How will we measure its success? How are we going to evaluate? When will it show results? When can we expect to start making income for it? What are the various risks involved in doing this project? This is another list of questions. How long will it take? What resources will we need? Do we have the internal resources available, or are we going to have to go find additional resources from outside our organization? If we find additional resources outside of our organization, what kind of risk does that bring in? What's the estimated cost? Do we need to train people? This is not an exhaustive list of things that we need to answer when we're taking on a project or not. This is an example of a weighted project screening matrix. So in this, we're evaluating 6 different projects, and we have put the criteria for our projects and the weight that we give that level of criteria. So if you see, we give a heavier weight to projects that have a strategic fit and an ROI, or return on investment, of over 18%. So we give those a weight of 3.0. The next weight we have is that we get 25% of sales from new projects. That's one of our strategic goals. Then we also have a weighted that we stay within our core competencies. And what is the urgency of the project? Is that project a compliance project that we might need in order to meet a compliance? So we see here then that we give scores to each one of these items, and that if we had to choose from just one of these 6 projects, we would go with project 5 because it has the highest weighted total. If we were allowed to accept more than one project, then we can go down and look at project 1, 3, and 6. We're probably not going to evaluate project 2 and project 4 any further right at the moment. We're going to do a couple of examples using this project matrix. So when we talk about applying a selection model, first we talked about this project classification. Is it strategic, operations, or compliance? Then we're going to select a model. What are our financial and non-financial goals, and how do those align with our organization's strategic goals? Where do we need to go for our resources? Do we have those resources within the organization, Or are we going to generate a request for proposal from external sources? Do we need to hire a contractor or an outside vendor? Then we would supply a request for proposal saying what we were looking for, and we would allow external companies to make bids to us for those external sources. We would use that selection model to rank the proposals, and then we would manage that portfolio of projects that we created. So if we selected 10 projects, we need to manage all 10 of those projects, sometimes at the same exact time. This is an example of a project proposal form where we've filled out the information about this project. We see that it's an infrastructure. That's one of the classifications that it's given. We have what business problem does the project solve? Questions here. Do we need, if we see further down, do we require internal resources? Yes. What's the estimated cost? How long will it take? Whether or not we're going to accept it. Here's a risk analysis. This one is for a 500-acre wind farm. So what are the 4 major risks for this project? We have to be able to use the land. Are we going to have price decreases, government incentives, new import taxes? And then what's the probability of those risks? Do we have the resources available and the technology available? This is another type of a project screening process where we decide whether or not we're going to reject or accept products. So we start with a project proposal idea. Then we have a self-evaluation of the project criteria, and we decide whether we're going to abandon or pursue the project. We evaluate the proposal, and then we review for risk balance. And then we decide, do we need to return it for more information, or do we have enough information that we can accept this or reject it? And if we do accept it, we're either going to hold it for future resources, or we're going to start assigning a project manager to it in order to assign resources to it. This is an example of a scoring priority screening analysis. So there are many different ways that we can use weighted score and matrices in order to score projects. When we're managing our portfolio system, we're going to want senior management input. They'll provide us guidance in creating that list of selection criteria and decide us how we want to balance our available resources. Then the governance team is going to publish the priority of every project. They're going to guarantee that our project selection process is open and free of those power politics that can cause issues or give us sacred cows. And they help us evaluate the progress of our current projects. So they're going to help us assign our resources and then evaluate how we are progressing towards meeting those project goals that we were assigned. And then the last, we have our portfolio of risks and different kinds of projects. So in this classification of projects, we have bread and butter projects, which are things that we work on with our current projects and services. These are also sometimes you might hear referred to as low-hanging fruit. They're easy to accomplish. They have low value. They don't take a lot of time. So these are the projects that we're really good at. We do regularly. These are going to be more operational projects. And then we have the pearls. So these are revolutionary projects using new technologies, advancing into new product lines. Okay. Oysters. Oysters are going to be those research and development things that create technological breakthroughs that we make a lot of money from. Our company might not even be in the industry where we would be looking at oysters. We might not be in the research and development kind of field. And that's possible. All companies are different. And then we have the white elephant. So these are projects that when we initially evaluated them, they seem like a good idea. But for some reason, they haven't gotten off the ground, or now we have new technology that has come out. They're no longer viable for some type of reason. For some reason, we no longer need that project and we would end the amount of resources that we have on that project. And that is the end of chapter 2. As I said earlier, I'm also going to do a couple of example videos where we go through one of those weighted scoring cards for a project to help you with your homework and case studies. And we're also going to look at doing the payback and profit valuation.